Take a deep breath and close your eyes for a moment. Imagine yourself sitting in front of your trading screen. The charts are moving, your heart is beating, and your hand hovers over the mouse. In that critical moment when you need to click, you freeze. Does this sound familiar? Right now, 95% of traders are losing money, not due to a lack of intelligence or analytical skills, but because they are fighting a war inside their own minds. Consider two traders who began their journey on the exact same day, both with $10,000 and both learning the same system. Trader A spent years meticulously studying every indicator imaginable, capable of predicting support and resistance with 80% accuracy. Yet, after 5 years, his account had dwindled to $3,000. Trader B took a different approach. He spent 6 months mastering one simple system, then dedicated 2 years exclusively to cultivating his mindset. After 5 years, his account had soared to $250,000. What accounted for this stark difference? Mark Douglas dedicated 18 years to working with traders to uncover the answer. His shocking discovery: the distinction between consistent winners and everyone else has almost nothing to do with market knowledge. Instead, it has everything to do with their way of thinking. The most successful traders possess a unique mental structure that enables them to trade without fear, while simultaneously preventing recklessness and fear-based errors. This mindset, comprised of several components, ultimately allows them to virtually eliminate the detrimental effects of fear and recklessness from their trading. When you acquire this mindset, you will be able to trade without fear, no longer susceptible to the multitude of fear-based errors stemming from rationalizing, subconsciously distorting information, hesitating, jumping the gun, or hoping. Once fear is gone, the reasons to make these errors disappear, and consequently they will virtually vanish from your trading. Lesson 1. The paradox of being right. Mark Douglas once encountered a brilliant technical analyst at a major Chicago brokerage firm, a man he considered among the best he had ever met, capable of predicting market movements with uncanny accuracy. One day, while observing soybean futures with his boss, a 40-year veteran trader, the analyst confidently predicted the market would hit a specific support price and reverse. As the market reached that exact level, the analyst declared, "This is it. This is the low of the day." Without a word, the veteran picked up the phone and calmly ordered, "Sell 2 million bushels at the market." Within 30 seconds, the soybean market crashed through the support level, dropping 10 cents a bushel. The horrified analyst watched his perfect analysis crumble. The veteran then turned to him and remarked, "Now, where did you say the market was going to stop? If I can do that, anyone can." This story reveals your first fundamental awakening. You do not need to know what happens next to make money. In fact, believing you know what happens next is one of the most perilous beliefs a trader can harbor. Consider this: millions of traders globally are analyzing the same charts. Any one of them, given sufficient capital and motivation, can move the market enough to invalidate your analysis. A central bank might intervene, an algorithm could trigger, or a fund could liquidate. Your flawless analysis is powerless against the collective actions of all market participants. This is not a flaw in trading. This is trading. The market can do anything at any moment. Once you truly accept this, you cease attempting to predict and instead learn to react. Your analysis transforms into a tool for identifying probability, not certainty. The best traders have evolved to a point where they genuinely believe, without a shred of doubt or internal conflict, that anything can happen. They do not merely suspect or pay lip service to this idea. Their conviction in uncertainty is so strong that it actively prevents their minds from associating the now moment situation with the outcomes of their most recent trades. By preventing this association, they maintain minds free of unrealistic and rigid expectations about how the market will express itself. Instead of generating expectations that often lead to emotional and financial pain, they have learned to make themselves available to seize whatever opportunities the market presents in any given moment. Lesson 2. The cycle of doom. Let's reflect on your own journey. Do you recall your first winning trades? That incredible feeling of ease? You saw an opportunity on a chart, clicked a button, and money appeared in your account. No fear, no hesitation, no doubt, just pure, effortless execution. You were in what Douglas calls the carefree state, what professional athletes refer to as the zone. Time seemed to slow, decisions felt automatic, and everything you touched turned to gold. Trading appeared to be the easiest way to make money, but then came your first significant loss. Not a minor setback, but one that truly hurt, one that made you question yourself. Suddenly the market, once a friend, became an enemy. It had betrayed you. It had taken your money. Trading was no longer fun. It felt dangerous. Here, the cycle of doom begins. You concluded that the problem was your lack of knowledge. If only you knew more about the market, you could avoid losses. So, you embarked on an intense quest for knowledge, studying harder, analyzing deeper, learning new indicators, patterns, and systems. But a strange phenomenon occurred. The more you learned, the more you expected from the market. The more you expected, the more the market disappointed you. Each time the market deviated from your analysis, it felt like a personal betrayal. This disappointment propelled you to learn even more, setting even higher expectations. You were trapped in what Douglas calls the cycle of doom. You weren't genuinely learning to trade better. You were learning to fear more sophisticatedly. Instead of simple fear of loss, you developed complex fears. Fear of being wrong, fear of missing out, fear of leaving money on the table, and fear of giving back profits. Each new piece of knowledge, rather than making you a better trader, provided another avenue for error. Every expectation created another opportunity for disappointment. The very knowledge you sought for protection became the source of your paralysis. Experiencing a few winning trades can easily convince almost anyone that trading is simple. Recall your own experiences. Those effortless trades that brought money flowing into your account with just a simple buy or sell decision. Combine the extremely positive feeling of winning effortlessly with making money, and it becomes almost impossible not to conclude that trading is easy. But if it's so easy, why is it so difficult to master? Why are so many traders at their wits' end, grappling with this obvious contradiction? If trading is indeed easy, and traders know it is because they have experienced its effortless nature directly, then how can it also be true that they cannot consistently apply what they have learned about the markets? Lesson 3, the mental environment. Douglas made a profound discovery. Your mental environment functions like a lens through which you perceive everything about the markets. Much like a computer's operating system dictates how it processes information, your mental environment dictates how you process market information. Your mental environment comprises memories, beliefs, attitudes, and expectations. Every trading experience generates a memory charged with emotional energy. These memories then form beliefs about how markets behave. These beliefs, in turn, create attitudes that color your perception, and these attitudes generate expectations about future outcomes. Here is the deadly process. You execute a trade that results in a painful loss. Your mind, in an attempt to protect you, forms the belief breakouts are dangerous. This belief then cultivates a cautious attitude toward breakout trades, which in turn generates the expectation that the next breakout will fail. When you encounter the next breakout setup, your expectation of failure causes you to hesitate. You enter the trade late, set your stop loss too close, and exit prematurely. The trade ultimately fails, not because breakouts are inherently flawed, but because your fear-based execution sabotaged it. This failure then reinforces your initial beliefs, strengthening the self-defeating cycle. You're not trading the market. You're trading your beliefs about the market. Until you fully grasp this, you will remain ensnared in self-defeating patterns. Our minds possess various mechanisms to shield us from information we have learned to perceive as painful. For instance, at a conscious level, we might rationalize, justify, or argue for staying in a losing trade. Common ways we do this include calling trading buddies, speaking to our broker, or consulting indicators we rarely use, all for the sole purpose of gathering non-painful information to deny the validity of the painful information. At a subconscious level, our minds automatically alter, distort, or specifically exclude information from our conscious awareness. In essence, we are consciously unaware that our pain avoidance mechanisms are either excluding or modifying the information presented by the market. Consider being in a losing trade when the market consistently makes higher highs and higher lows or lower highs and lower lows against your position, while you refuse to acknowledge the loss because you focus solely on the few favorable ticks. On average, you might only get 1 out of 4 or 5 ticks in your direction, but it doesn't matter because each favorable tick convinces you the market has reversed and is returning. Instead, the market continues to move against you. Lesson 4. The market owes you nothing. Here is a truth that might sting. The market owes you nothing. Not a single penny, not a winning trade, not even fairness. When you incur a loss, it is tempting to say the market took my money or the market stopped me out. However, the market did nothing to you. The market simply facilitated the transfer of money from your account to another trader's account. This is the zero-sum game you have entered. Every dollar you gain originates from another trader's loss. Every dollar you lose flows into another trader's pocket. The market is a neutral mechanism for price discovery and wealth transfer, nothing more, nothing less. Right now, thousands of traders are scrutinizing the same charts you trade. Each perceives a different opportunity based on their unique beliefs, fears, and expectations. The market is indifferent to your analysis, your needs, or your dreams. It merely reflects the collective actions of all participants. But here lies the liberating insight. If the market is not actively doing anything to you, then you possess complete power over your results. You do not need the market to change. You do not require special conditions. You simply need to alter how you think about and interact with the market. Taking responsibility means acknowledging and accepting at the deepest core of your identity that you, not the market, are entirely responsible for your success or failure as a trader. The market's primary function is to facilitate transactions, but in doing so, it also provides an endless stream of opportunities for you to extract money from it. When prices move, that movement embodies the collective actions of every individual participating at that moment. The typical trader desires the market to fulfill his expectations, hopes, and dreams. While society might operate this way, markets certainly do not. In society, we can reasonably expect others to behave responsibly. If they fail to do so and we suffer as a result, society provides remedies to correct the imbalance and restore us. The market, conversely, bears no responsibility to grant us anything or act in any way that would benefit us. This may not be how markets are advertised or the impression they wish to project, but the reality is, every trader participates for their own benefit. The only way one trader can profit is if another trader loses, whether the loss is in actual dollars, as in a futures trade, or lost opportunity, as in a stock trade. Lesson 5. The 5 fundamental truths. Mark Douglas identified 5 truths that, when fully embraced, will revolutionize your trading. Do not merely understand them intellectually, feel them, embody them, and allow them to transform your perception. Truth 1. Anything can happen. At any given moment, for any conceivable reason, the market can do something that utterly demolishes your analysis. A sudden news event, a massive institutional order, a technical glitch, all can instantly invalidate your perfectly reasoned predictions. Accept this completely, and you will cease to be surprised by market behavior. The markets are a composite of individuals, and individuals can act in any way at any moment. This implies that regardless of your analysis, no matter how certain you feel, the market can prove you wrong in an instant. A single trader with sufficient capital can unilaterally move the market against your position. An unexpected news release can reverse even the strongest trend. A technical error can trigger a cascade of orders that obliterate your stop loss. Truth 2. You don't need to know what happens next to make money. Casinos, for instance, do not know which specific bet will win, yet they consistently generate profits. They comprehend and leverage probability. You can too. Release the compulsive need to predict, and instead embrace the power of precise edge execution. This truth directly contradicts the prevailing belief among most traders that accurate market direction prediction is the key to success. Most traders dedicate years to perfecting their predictive abilities, adding more indicators, learning more patterns, and developing increasingly complex systems. However, consider a casino. Does the casino know which specific bet will win or lose? No. Do they need to know? No. They consistently make money because they possess a statistical edge that plays out reliably over a large number of bets. Truth 3. There is a random distribution between wins and losses for any given set of variables that define an edge. Your system might boast a 60% win rate, but the precise sequence of wins and losses is inherently unknowable. A streak of 10 losses followed by 20 wins is entirely plausible, as is an alternating pattern of wins and losses. Accept the randomness of distribution while maintaining unwavering trust in the reliability of probability. This is arguably the most challenging truth for traders to genuinely accept at a functional level. Your trading system might have a 60% win rate over a long period. However, this does not imply you will win exactly 6 out of every 10 trades in a predictable sequence. The distribution of wins and losses is random. You might experience 10 consecutive losses followed by 15 consecutive wins. You might alternate between wins and losses. You could even endure a period of small wins and large losses followed by large wins and small losses. Truth 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. It is not a guarantee nor a prediction, but simply a statistical advantage that materializes over time. Your edge holds no significance on any single isolated trade, but it is paramount over a series of trades. Note the crucial word here, probability, not certainty, not guarantee, not prediction, just a higher probability. If your system exhibits a 60% win rate, it means that out of 100 trades, approximately 60 will be winners and 40 will be losers. It emphatically does not mean that any specific individual trade has a 60% chance of winning. This is a critical distinction that most traders fail to grasp. Each individual trade is a unique event with an inherently uncertain outcome. Truth 5. Every moment in the market is unique. That setup that appears to be an exact replica of last week's winner, it is not the same. Different participants are involved, the market context has changed, and different underlying forces are at play. Cease imposing past patterns onto present moments. Trade what is, not what was. This truth directly challenges our mind's natural inclination to categorize and pattern match. While it is true that markets display patterns and history often rhymes, no two moments in the market are ever precisely identical. The participants are distinct. The context is different. The background conditions have shifted. That setup that looks exactly like the one that performed perfectly last week, it is not the same. It could behave completely differently. When you fully internalize these 5 fundamental truths, fear becomes impossible. How can you fear loss when you have already accepted that anything can happen? How can you feel the need to be right when you know you do not need to know the future? How can you be surprised when you expect random distribution of outcomes? Lesson 6. The dog story. How your mind creates your reality. Let me share a story that perfectly illustrates how your mind inadvertently sabotages your trading. A young child encountering a dog for the very first time runs towards it with natural curiosity and excitement. However, this particular dog is aggressive. It attacks, biting the child severely before adults can intervene. The child is traumatized, a pain and fear indelibly etched deep into his memory. Months later, the child encounters another dog. This second dog is entirely different. Friendly, gentle, tail wagging, wanting only to play. But what does the child perceive? He sees a monster. His body floods with the same terror he experienced during the attack. He screams and instinctively runs to his mother for protection. Is the child perceiving reality? No, he is projecting his past onto his present. His mind instantly associated the general shape of a dog with the intense pain stored in his memory, triggering all the accumulated fear and trauma. He is literally incapable of seeing the friendly dog in front of him because his fear-based expectations filter out all contradicting information. This is precisely what occurs every time you trade. Your last losing trade is akin to the first dog. It creates a painful memory. The next similar setup is like the friendly dog, completely different in reality, but perceived as identical through your lens of fear. You are unable to see the valid opportunity because you are blinded by projected pain. Your mind automatically associates current market patterns with past painful experiences. This is why you freeze when you encounter familiar setups, why you enter trades late, exit prematurely, or avoid valid trades entirely. You are not trading current market reality. You are trading your traumatic memories projected onto neutral price movements. The market, like the friendly dog, is merely displaying information. The perceived threat exists entirely within your mind, generated by associations of which you may not even be consciously aware. Until you comprehend this projection mechanism, you will remain its prisoner, seeing danger where only opportunity exists. Our minds are hardwired to associate and link anything in the external environment that shares similar qualities, characteristics, properties, or traits with anything that already exists in our mental environment as a memory or distinction. This innate tendency for our minds to associate is an unconscious mental function that occurs automatically. It is not something we consciously think about or make a decision regarding. An unconscious mental function is analogous to an involuntary physical function, like a heartbeat. In the example of the child fearing dogs, the second dog, or any other dog he encounters thereafter, does not have to be the exact dog that attacked him for him to experience emotional pain. There only needs to be enough likeness or similarity for his mind to establish a connection between the two. This connection, in turn, will cause the negatively charged energy in his memory to be released throughout his body, resulting in him being overcome with a very uncomfortable sense of foreboding or terror. Lesson 7. Think like a casino, not a gambler. Imagine you own a casino in Las Vegas. Every single night, players win money at your tables. Sometimes they win big. Jackpots, hot streaks, perfect sessions. Do these wins concern you? Do you nervously pace the floor, worrying about them? Do you consider altering the rules or shutting down tables? Of course not. You possess a profound understanding of probability. You know that over millions of bets, your mathematical edge unfailingly guarantees profit. Individual outcomes are utterly irrelevant. The law of large numbers is inevitable. If players wager $100 million at your blackjack tables this year, your 4.5% edge ensures an approximate profit of $4.5 million. This profit encompasses all the big winners, all the hot streaks, all the lucky hits. It also includes all the losers, all the busted hands, all the unfortunate souls. When aggregated, the edge invariably manifests. Mathematical certainty emerges from random chaos. Now, observe the gambler's mindset. He fixates obsessively on the next hand. Will this bet win? His emotional state swings wildly with each outcome. If he wins, he's a genius. If he loses, the game is rigged. He desperately seeks patterns in randomness, believes in hot streaks, and convinces himself he can influence outcomes through rituals or sheer force of will. Which mindset do you bring to your trading? Do you obsess over the next trade like a gambler fixates on the next hand, or do you execute your edge with the calm certainty of a casino owner? Do you celebrate and despair with each individual outcome, or do you remain emotionally neutral, understanding that probability ultimately handles the results? Professional traders think like casino owners. They grasp that their edge manifests over hundreds of trades, not in the outcome of the very next trade. They neither predict nor hope. They mechanically execute their system, allowing mathematics to handle the outcome. They maintain the same emotional state regardless of whether they are winning or losing. knowing that both are integral parts of the overall distribution. Casinos consistently generate profits day after day, year after year, by facilitating events that have purely random outcomes. Simultaneously, most traders, despite believing that market behavior is not random, seem unable to produce consistent profits. Shouldn't a consistent, non-random outcome yield consistent results? While a random outcome produces random, inconsistent results, what casino owners, experienced gamblers, and the best traders understand, which the typical trader struggles to grasp, is this: events with probable outcomes can produce consistent results provided you can establish favorable odds and there is a sufficiently large sample size. The best traders approach trading as a numbers game, much like casinos and professional gamblers approach their respective endeavors. Lesson 8: The Three Sacred Rules and the Mechanical Stage. Mark Douglas identified three fundamental rules that distinguish professional traders from mere gamblers. Violating any of these rules is tantamount to proclaiming your belief that you can predict the future. Rule 1: always predefine your risk before entering a trade. This means knowing precisely how much you are willing to lose before you even click the buy or sell button. It's not about hoping to lose or merely planning for a loss, but genuinely being willing to lose that amount. If losing that specific amount would cause emotional pain or financial hardship, then you are risking too much. Predefined risk extends beyond just setting a stop loss. It encompasses complete mental and emotional acceptance of the potential loss. Most traders violate this rule because they are unwilling to accept the possibility of loss. They enter trades thinking, "This one is going to work," or "I'll decide where to exit if it goes against me." This is the gambler's mentality, a mindset rooted in the belief that you know what will happen next. When you predefine your risk and genuinely accept it, something profound occurs. The fear of loss dissipates. How can you fear something you have already accepted? Rule 2: cut your losses without hesitation when the market touches your stop. No questions asked, no second guessing, no giving it just a little more room. When your stop is hit, you exit. Period. Your stop loss represents the exact point where your statistical edge no longer exists. Remaining in a trade beyond this point is pure gambling, fueled by hope for a miracle rather than disciplined execution of a system. Why is this rule so incredibly difficult to follow? Because exiting at a loss triggers deep psychological pain. It means admitting you were wrong, accepting failure, and taking real money out of your account. Your mind will conjure dozens of reasons why you shouldn't exit, why this time is different, why the market is about to reverse in your favor. But you must understand this: your stop loss is not just a price level. It is the critical point at which your edge ceases to exist. Rule 3: have a systematic way to take profits. Hope is not a profit strategy. Let's see what happens is not a plan. You must possess objective rules for capturing gains. Without systematic profit-taking, your emotions will inevitably control your exits. Greed will whisper, "Hold for more," while fear screams, "Get out now." You need mechanical rules that effectively remove emotional decision-making from the equation. These three rules collectively form what Douglas refers to as the mechanical stage of trading development. You must transform into a trading machine. No interpretation, no discretion, no creativity, just pure, robotic execution of your predefined rules. Only after mastering mechanical trading can you responsibly introduce elements of intuition or discretion. It is imperative that you progress through this mechanical stage before you can trade intuitively. Just as a pianist must master scales and exercises before improvising, a trader must first master the mechanics. Most traders attempt to bypass this crucial stage, which is precisely why most traders fail. For your next 20 trades, commit to being mechanical, not creative, not intuitive, mechanical. This is the precise method by which you will build the neural pathways of a true professional, not predefining your risk, not cutting your losses, or not systematically taking profits are three of the most common and typically the most costly trading errors one can make. Only the best traders have completely eliminated these errors from their trading. At some point in their careers, they learn to believe without a shred of doubt that anything can happen and to always account for what they don't know, for the unexpected. Lesson 9. Your 30-day transformation protocol. Knowledge without action is merely entertainment. Here is your practical, actionable 30-day transformation protocol. Week 1, awareness phase. Halt all live trading. Begin paper trading, meticulously documenting every single thought, emotion, and physical sensation you experience. Write continuously. This looks good. What if I'm wrong? I can't afford another loss. Document all the internal mental noise. Each evening, delve deeper into your core beliefs through sentence completion exercises. Money is, success means, I deserve, the market is, do not judge whatever emerges. Your objective is to map your current mental environment comprehensively. By the end of week 1, you will possess a comprehensive picture of your psychological trading patterns. You will clearly discern how fear and greed manifest in your thinking. You will understand precisely which beliefs sabotage your execution. You will know exactly what needs to change. Week 2, reprogramming phase. Morning, engage in 20 minutes of visualization. Vividly see yourself executing mechanically, following your rules despite any internal emotions. Feel the calm confidence that accompanies systematic execution. Continue paper trading with full emotional engagement. When fear or greed arises, acknowledge them, then consciously choose to act according to your rules anyway. You are learning to operate independently of your emotions, not to eliminate them. Evening, celebrate every single instance of disciplined behavior. Did you follow your setup rules despite feeling fear? That's a victory. Did you exit at your stop without hesitation? Another victory. Did you skip a marginal trade? A victory. For each limiting belief you identified, create and consistently repeat a specific empowering counterbelief. But do not merely recite words. Feel the truth of this new belief. Imagine trading from this new perspective. See yourself executing flawlessly while firmly holding this new belief. Week 3, integration phase. Resume live trading, but with quarter-sized positions. The goal here is not profit. It is about practicing new patterns with real, albeit small, consequences. Document your execution quality, not your financial results. Maintain dual awareness. Part of your attention on the markets and part observing your internal state. When old unhelpful patterns arise, pause, take a deep breath, reconnect with your new beliefs, and then act from discipline. After each trade, immediately document 2 key things: whether you followed your rules perfectly and what your internal emotional experience was like. Do not focus on whether the trade made or lost money. Focus entirely on execution quality and your psychological state. Week 4, expansion phase. Gradually increase your position size while vigilantly monitoring for the reemergence of old patterns. If fear or greed returns strongly, immediately reduce your position size. Build consistency in your execution before actively seeking larger profits. Continue all practices until mechanical execution becomes genuinely natural. Judge your progress based on execution quality, not solely on your account balance. Perfect execution, even if it results in a loss, is superior to profitable rule violations. Incorporate a weekly review and planning session. Every Sunday, comprehensively review your week's trading from a psychological perspective. What patterns do you notice? Where are your strengths? Where do you still struggle? Plan specific focuses for the upcoming week based on your discoveries. Closing. The Matrix moment. You have been living in 2 distinct realities. In one, you feel the compelling need to predict, control, and always be right. In the other, you flow effortlessly with probability, embrace uncertainty, and consistently profit from chaos. Like Neo in the Matrix, you now possess the vision to see the code. The market's movements are merely numbers flowing. Your true job is not to predict this code, but to strategically position yourself where probability favors your action. You now face three choices. The blue pill. Return to a life of futile prediction, analysis paralysis, and remain among the 95% who lose money. The red pill. Fully accept uncertainty, think in terms of probabilities, and join the exclusive 5% who achieve consistent profitability. The black pill. Know the truth, but do nothing with it. This is undeniably the worst choice. The market continues its eternal, impartial dance, offering identical opportunities to everyone. However, whether you can truly perceive and act upon these opportunities depends entirely on your evolved mental framework. Will you persist in fighting against uncertainty, or will you finally learn to dance gracefully with it? Every master trader stood precisely where you stand now, confronting the very same choice. They were not inherently special. They simply made the conscious decision to think differently. Their profound transformation commenced with one simple, unwavering acceptance. I don't need to know what happens next. Your first assignment. Tonight, write down one significant limiting belief you hold about trading. Perhaps it's I must be right or the market owes me something. Then immediately write its empowering replacement. I follow my edge or I earn from probability. Post this where you will see it every single morning. Read it, feel it, become it. The market has not changed. It never will. It will continue doing anything at any moment. The only variable that can change is you. Remember Mark Douglas's final poignant message. The answer is not in the market. The answer is in your mind. Change your mind, change your results. The zone awaits you. Not as a distant destination, but as a transformed way of being, not exclusively for the chosen few, but for anyone willing to align their mind with the immutable reality of the market. You now stand at a crucial crossroads. Behind you lies the well-worn path of the 95%, the path of prediction, control, fear, and inevitable failure. Ahead lies the disciplined path of the 5%, the path of probability, acceptance, and consistent profitability. The choice has always been yours, and it always will be. Welcome to Trading in the Zone. Welcome to the 5%. Your journey begins now. The market hasn't changed. You have.